Welcome into the Organized Investor Show, brought to you by Tennessee Wealth Management. It's me, Erik Ainge, your host. Today, ladies and gentlemen, we're going to ask the most uncomfortable question of the year. If your current financial advisor's chair were empty tomorrow morning, would you walk in this afternoon and hire him? Not, would you keep him? Different question. Would you hire him today, knowing what you know now with everything else available to you? Most people, if they're being honest with themselves, would not. And yet they keep them anyway. That is what we're calling the inertia hire. And before we leave this opening with me talking, because, well, I like to do that, segment one is the invisible bill. What inertia actually costs you year after year, even when nothing visible is happening on your statement. Segment two, the interview they can't pass. The questions any honest advisor should be able to answer cold and why most of them cannot. Segment three, the Tuesday that never comes. What you actually do about this week, not someday. 3 angles, 1 umbrella question. If the seat were empty, would you hire him today? Again, it's me, Erik Ainge, former UTQB, host of the Erik Ainge Show on The Animal. And let's bring with you the starting lineup. To my right is Jerry Goodman in the red gloves. Jerry's a certified financial planner with 43 years in the business. 43 years. He's been doing this longer than I've been alive.
I think it's actually 44 now, Dad.
It's got to be getting close.
It's a rounding error.
You've been doing this a long time. He has seen every market cycle, every rate environment, every panic, and every euphoria. One of the steadiest hands you'll ever meet. He runs the in-house investment management at the firm with Jared Hubbard, which means when we talk on the show about how money is being managed, we're talking about the guys right there. Jerry Goodman, Jared Hubbard, 2 feet from us right now in the flesh. Next to Jerry in the blue gloves is Megan Hubbard, Jerry's daughter. Megan was a first grade teacher at CAK before she came over to the firm. She has a master's degree in curriculum and instruction. She actually knows how to teach humans. Well, she's around us, so we know that, which is a much rarer skill in financial services than you would think. Megan translates jargon into plain English, and she helps us do it all day long, and she's helping you listen right now. And then to my left, my beautiful wife in the white gloves, Susan Ainge. Susan is currently studying her Series 7. She brings the perspective of somebody who was where most of you are sitting 6 months ago, fresh, asking the questions you would actually ask and not afraid to ask them on air. Welcome, team.
Thanks, Erik. And so this actually is the show where I'm going to tell you what I would have asked my own family advisor, my own financial advisor, if my dad had actually not been my financial advisor. Okay, so when you frame this as an interview question for your advisor, I would say, would I hire him today fresh? It is a completely different question than should I keep him, right? So if you're thinking about your advisor, I would think to yourself and ask yourself this question, would I hire him today fresh? Not, should I keep him?
Well, and that's the trick about all this, isn't it? Erik mentioned inertia, and that's really the most underrated, let's call it underrated force in personal finance. I've seen people stay with the same advisor relationship for 15, 20, 25 years, for one reason. It's not because the advisor was good, because changing it just kind of required some effort. This human brain, it hates doing effort, okay? That is not a personal failing. It's just basically how we're wired.
I want to come at this as the person who has not been in the industry for 40 years, because I think most listeners are where I am. When you're young and you don't know anything, the interview is just, do I like this person? You sign the paperwork because the guy seems nice, and then the 10 years go by and you have never once gone back and asked yourself if you would hire him again.
And that is a central problem of this whole show that we're doing today. Most people hired their advisor without an interview at all. They were referred by a friend, or it was their parents' guy, right? Or someone at church they played golf with. It was a handshake. A handshake is fine for a barbecue, guys. It's not how you select the person managing the savings of your entire life. And I never would have done that when I was, picking a football coach. So why don't we go with a football analogy? Because that's what I'm going to do. Head coaches in the NFL get fired all the time, guys. But offensive coordinators, the number of times a head coach keeps the same OC for years past their expiration date is staggering. And it's almost always for the same reason. Firing the OC means admitting you hired the wrong guy. So the head coach keeps him because that's his guy. And they made that decision. And the offense stays mediocre for another season and another until the head coach gets fired himself.
And that's what's happening in millions of households with financial advisors right now. The relationship is the offensive coordinator. The household is the team. Nobody is willing to make the call. Meanwhile, your retirement is the playoff window, and it does not stay open forever.
I've heard this for years. I should have done this years ago, probably 400 times in the 43 years I've been in this industry, okay? Every time somebody finally moves over to us, they say that, okay? Compounding works on the advisor's decisions too. And the cost of staying grows every year you stay. This is not a guilt trip, folks. This is just the mathematics of it.
And what surprised me, watching this from inside the office for 6 months, the thing that holds people back is not the math. It is the imagined awkwardness of the conversation. But nobody actually has to have that conversation. The new firm handles the transfer paperwork. You sign once. That is the whole switch.
Which is the perfect bridge into the actual numbers. Because if we're going to ask the listener to interrogate their current advisor, we have to be willing to be interrogated ourselves. Through December 31st, 2025, here is what the team performance looked like compared to the Dow Jones.
So last year through 2025, our track record was 36.3% on average versus the Dow at 13%. 3-year average, 19.3% versus the Dow at 13.2. 5-year average, 13.3 versus the Dow at 9.4. And over an even longer period, 7 years, the average return for these 198 clients, 16.7% versus the Dow at 10.1. Oh, and here's our favorite part. Past performance is no guarantee of future results, and these returns can vary based upon the investment objectives and the tolerance of risk for each of these investors. Now, that language exists. Basically, the law requires it because it's actually true as well. And these numbers are also true.
Yeah, it's like, hey, not a guarantee, but we're kind of killing it. And the gap between those two columns, guys, that's the conversation we're having. Most listeners don't realize the numbers come from selectivity, not luck. At the moment, we own about 95 stocks at 1% each in-house, selectively.
The biggest mistake that the average mutual fund is going to make is what we would call diversification, okay?
No.
If you have 15 funds and I have maybe 400 or 500 stocks in each one, you have 4,000 or 5,000 stocks spread over all these different companies. You basically own the entire world. You have an expensive index that's basically charging you for the privilege of being mediocre to getting average returns. The irony is that most clients think they're being responsible. They're so diversified, though, they can't possibly outperform the market because they're just an average of the entire market. And they're basically paying for that process as well.
And the numbers are public. That's the part the listeners need to actually hear, okay? So you can go to our website, theorganizedinvestor.com. The last 4 digits of the client account numbers are published as well, so anyone can verify their own returns against what we say on the radio. We're showing the homework, okay? Most firms would not dream of publishing what we actually publish on our site.
One of the many reasons we're different. And that brings me to the framing of this whole first segment. I'm calling it the invisible bill. So, Susan, set it up for us because you came from the listener side just 6 months ago.
The reason inertia is so expensive is that it does not feel like spending. You do not write a check every year that says, fee for staying with the wrong advisor. There is no line item. That cost is invisible. It is the gap between what you got and what you could have gotten. Invisible costs are the most expensive kind because nothing on your monthly statement ever makes you flinch. A bad cell phone plan, though, you would switch in a week because the bill comes in and you see it. A bad advisor relationship, you stay in for 20 years because the bill never comes. It just lives inside the gap.
And the size of that gap, the actual dollar amount of the invisible bill, is what the firm's 2% improvement message is about. So I'm going to say it for you right here. The firm's stated goal is to improve client performance by at least 2% annually versus a comparable benchmark or prior advisor. 2% improvement per year on $1 million portfolio compounded over 20 years is roughly $485,000 additional dollars. $485,000. That's a beach house. That's 2 college educations. That's the difference between retiring at 63 and retiring at 70.
And the 2% comes from basically 4 particular places. Listeners, write these down if you want to. Number 1, lower advisory fees than virtually any financial advisor you're going to find. Our fee structure versus what you're probably typically paying than big wirehouse is probably about 1/4 point less. Number 2, we have lower cost because we avoid mutual funds per se. Okay, no expense ratios, no 12B1 marketing fees, no internal trading costs, all piled on top of that. Number 3, less diversification by investing in actual common stocks, not mutual funds. At the moment, we have about 95 carefully selected stocks with about 1% each versus thousands of individual indirect holdings if you were in mutual funds. And that's what we call diversification, and we've talked about many times. And then number 4, we're much more selective in our stock selection. We use a lot of high-quality dividend growth stocks off of the DSIP list through Wells Fargo's research. And we also look for fear situations which happen in the market. We call those bargain opportunities. We had COVID in 2020, the banking crisis of 2023, tariffs last year in 2025, made a ton of money off that. This year we have the AI disruption sell-off. We have the Iran conflict going on. That's where this 2% compounds up to $485,000 year after year quietly. While the inertia hire is basically busy doing nothing with your account, where they have you in a bunch of mutual funds, they don't do much with it, and that's why you're getting mediocre returns. Those 4 sources is where that invisible bill is coming from, that you're paying, that you may not even realize. They're also the reasons that they don't have to stay invisible anymore because we're bringing them up and letting you see them.
And there's no headline that ever says, you just lost $485,000 to your advisor.
You said, what?
Exactly. That's the worst part of an invisible bill. It's invisible. A bad cell phone plan, you cancel it in a week, right? You see it on the paper. A bad advisor relationship, you stay for 20 years and you don't even know that it's bad.
All right, hold that thought because we need to take a beat and we need to talk about something the firm does every single month in person. For listeners who have never been, we run a free workshop every month, and it might be the lowest pressure way to actually evaluate all this for yourself. And I think you should come see us and hang out with us. Megan?
Yeah, let me share a little bit about the Organized Investor Workshop that we hold every month at Chesapeake's on Parkside Drive in Knoxville. That's happening at 6 o'clock at each of those. It includes a full meal, some adult beverages if that's your thing. It is not a sales floor. It is not a steakhouse cruise pitch. It is an actual workshop meant for educational purposes. I wouldn't be participating if it wasn't because I am the teacher in the group. You walk away with our 60-page workbook. We walk through the approach, the strategy, and the math you have been hearing this hour. And one lucky attendee is going to leave with a football that Erik has signed, including a tee.
The crowd goes wild.
Exactly. You can reserve your seat at theorganizedinvestor.com, or you can call us and leave us a message on our reservation line at 865-415-2058.
And again, this is not an annuity pitch. It's the nicest steakhouse in town, okay? It's educational. Some people come back maybe several times before they ever pick up the phone and really want to sit down and talk to us. And that's fine. Actually, that's exactly how it should work. We want you to understand what we offer, and you'd be comfortable if you want to have a discussion with us.
I think you guys should RSVP and come. And while we're on the in-person side, let me plant a quick flag on something we will come back to in detail in segment 2. The firm has something I genuinely think is the best deal in financial services anywhere, and it costs the listener absolutely nothing. It is a complete set of estate planning documents, real documents, completely free. And here's what most listeners do not realize about the offer. You don't have to be a client, and you don't have to come to the workshop, although we just told you we want you to come. We do. You don't have to come to the office, although it's a great environment. It's a great time. You don't have to. It's a 5-minute phone call, though. That's it. If estate planning has been on your someday list for a decade, then this show is your sign.
And just to keep listeners anchored on the offer before Jerry walks the full thing in segment 2, it is free. It is a 5-minute phone call, no client status required, no workshop attendance required, no office visit required, nothing.
All right, back to the central thought experiment. You do not have to fire your advisor today, right? You don't have to feel stressed out. What I'm asking is for you to do the interview that you didn't do the first time. Pull out your statement, go to theorganizedinvestor.com and compare. And here's where I want to talk directly to you listening right now. You compare phone plans, guys. You compare car insurance. You compare grocery prices at 2 different stores. You compare coffee shop item 10 miles from your house. You compare everything. Everything. What are you waiting for comparing this? Pull out your statement tonight. This is all the homework is. Pull out, go to our website, and check it.
6 months ago, I was a listener, and the hardest part of that question is not answering it. It is letting yourself ask it honestly. Most people protect themselves from the answer because then they would have to do something. But not asking, it costs you the same money as asking it and ignoring the answer. So you might as well just ask.
I'll tell you what most people are actually scared about when they imagine doing this. It's the conversation. It's the paperwork. The, what if I'm wrong? It's not that it's that hard, okay? The paperwork is basically just one signature. The conversation you do not have to have. They handle the transfer, okay? And what if I am wrong? The public numbers exist precisely so you don't have to take them at their faith.
And here's the teacher in me. That is the same dynamic that holds students back from speaking up in class oftentimes. They imagine the embarrassment will be much worse than the real thing. Same here, honestly. I think we mostly do this as humans. The fear of the conversation is always bigger than the conversation itself every single time. Meanwhile, the invisible bill just keeps compounding.
And that is exactly where we will leave segment one, guys. It's the invisible bill, and the cost is real. Roughly $485,000 of additional value over 20 years on $1 million account. And we try to do that in the 4 ways we've been telling you guys. It's lower fees, avoiding mutual funds completely, less diversification with more selectivity, right? You can't see a lot of this on your statement, which is the whole problem. That's what we're talking about. All right, so when we come back in segment 2, the interview they can't pass. The questions any honest advisor should answer cold, should know, and why most cannot. Don't go anywhere. You're listening to the Organized Investor Show right here on News Talk 98.7.
Want to meet the team from the Organized Investor in person? Join us at a free Organized Investor workshop. You'll get a 60-page workbook, a great meal, and learn how to get free estate planning documents through our partner, Trust and Will. Our next workshop is Tuesday, June 30th at 6 p.m. at Chesapeake's Restaurant on Parkside Drive in West Knoxville. There's no cost or obligation to attend. However, seating is limited. So reserve your spot at theorganizedinvestor.com or call 865-415-2058. That's 865-415-2058. Erik Ainge is the host of The Erik Ainge Show on 99.1 The Sports Animal, weekdays from 9 to noon. Erik, his wife Susan, Megan Hubbard, and Jerry Goodman are all affiliated with Tennessee Wealth Management and Prospera Financial Services in Dallas.
And we're back to the Organized Investor Show, brought to you by Tennessee Wealth Management. Guys, right here on News Talk 98.7. It's me, Erik Ainge, and if you just joined us a little bit late, what we're doing, we are running through a thought experiment all hour. If your current advisor's chair were empty tomorrow, would you walk in today and would you hire them? Not keep them, would you hire them? It's the inertia hire. Segment 1, we walk through the invisible bill, the $485,000 cost of staying that never shows up on a statement. This segment, we're going to give you the actual interview, the questions any honest advisor should be able to answer right off the top of their head. Quick reintroductions. Jerry Goodman, certified financial planner for 43 years, runs the in-house management, finance the money right there with Jared at Tennessee Wealth Management. Megan Hubbard, Jerry's daughter, former teacher, master's in curriculum and instruction. And my wife, Susan, 6 months in the office, currently studying for her Series 7, giving us that fresh perspective. And then, of course, me, the QB, the sports guy, and the one that's in the host chair, I might add. You know, I am in the host chair, guys.
Yeah, we can see that.
Yeah.
That doesn't necessarily mean you're the host of this show.
But I said it.
Just kidding. You can be the host.
But I said it.
I guess since you're sitting in the chair, we'll let you be the host.
Thanks, Megan.
All right. Well, since you're the host, I am going to go first now.
Yeah, it's fine. You're
okay.
up.
Okay, perfect. So question 1, and this is the one nobody asks. What is your investment process in your own words in 2 minutes or less without reaching for a brochure, okay? You would be amazed how many advisors cannot answer that question without a deck. If they cannot articulate what they personally do, not what their firm does, that is the answer, because the brochure is marketing. Marketing is not management.
I could probably answer that little question for us in about 15.2 seconds. As any advisor should be able to. Currently, we've got about 95 individual stocks in-house invested in about 1% each in all of these companies. We use dividend growth stocks as a core, and we also basically can quickly move into some what we call bargain opportunities as they pop up, like COVID, the banking crisis, the tariff scare last year. Right now, we're in the middle of an AI software sell-off. This is where how we manage money for clients. This is why we have this extremely good performance over the last 7 years, and why our clients have basically been able to materially improve their financial future. Now, if your advisor needs 20 minutes and a deck from a PowerPoint to explain all that, you're not paying for management, folks. You're basically paying for marketing.
That was more than 15.2 seconds, but I'll let it slide. It was less than 20 minutes, so it'll slide.
It was a long elevator ride, Megan.
Okay.
Question 2, and this one is mine because as somebody studying for the Series 7 right now, I just learned how this actually works. How do you get paid? Not what's the fee. Anybody can quote the fee. How are you actually compensated? Are you paid more if I buy this product versus that one? Are you paid more if you put me in an annuity versus an index fund? Because if the answer is yes, we have a built-in problem before we have even started.
And this is where the firm has to be transparent about itself. Our team is a percentage fee firm. That's how we get paid. The fee scales with the assets. When your account grows, we make more. When it shrinks, we make less. There's no kickback for sticking you in a certain product. They do not have a commission on an annuity. They do not get paid by a fund company. That structure exists for a reason, Jerry.
Exactly. And listeners, the right question is not, is your fee high or low? The right question is really, what behavior is your fee paying for? Think about that for a minute, okay? Within the percentage fee world, which is what we're in as well, there's a huge gap between actively managing money and basically collecting a fee to drop you into some sort of model portfolio. Now, a model portfolio means somebody at corporate has built 5 buckets, and you're going to get dropped in one of those. Same fee, entirely different work.
And let me name something specific here because the firm has been historically too polite about this one. The biggest version of same fee, totally different work in the industry, it has a name. It's called a mutual fund advisory account. Jerry, can you walk people through what that actually is?
Happy to. So a mutual fund advisory account is a brokerage account where the client pays an advisory fee on top of holding mutual funds within that account, okay? Typically, maybe 1.5% advisory fee on top of the fees that are buried inside of those underlying funds. So that can include things like 12B1 expenses, internal trading costs, all of that. So there's really several layers of fees inside of the account, the advisory fee as well as the internal cost of the funds itself. So the client's basically paying for advice on top of paying the mutual fund company to do something that resembles the same job. And the hidden 12B1 fees, they're basically buried in the prospectus that no one's going to see. Every December, the client can get hit with a capital gain distribution for the trades that the fund made that the clients really didn't have any knowledge of. The client is a passenger in this little trip. They're not the driver. And the advisory fee compounds against that client every single year, whether the fund performs or not. That is a structure that most listeners are actually in right now, and they have no idea.
And it sounds really technical, but the takeaway for listeners is really simple. If you are in a mutual fund advisory account, you are paying somebody an advisory fee on top of holdings that already charge you an internal fee. There are 2 layers here, sometimes maybe even 3. So check your statement for the words advisory fee plus mutual fund tickers, okay? If both of those are present, you have it. Most clients I've met do not know that this is what they have signed up for.
Question 3, and this is the one I think nobody asked, but everybody should. Show me your numbers, not the firm's composite returns from a glossy brochure, your actual client returns over the last 1, 3, 5, 7 years against a real benchmark. And if they can show you, ask the next one. Are these published? Can a stranger look them up?
And that is exactly what they do at theorganizedinvestor.com. Numbers are published. The last 4 digits of client account numbers are listed. You can verify them. Through 12/31/2025, 1 year was 36.3% versus the Dow at 13. The 7-year average, 16.7% versus the Dow at 10.1. Again, past performance is no guarantee of future results. Returns vary by account. Yeah. Okay. Most firms in the industry will not show you their performance. Most will not even show you a benchmark comparison. Hi, that's what we're doing here. Try this experiment next week. Ask your current advisor for his 5-year number versus the Dow in writing and watch their face change.
And the reason these numbers hold up so well that we talked about in segment 1 is called selectivity. It's not luck, okay? The 4 sources of the 2%. And just to keep the listener anchored, that 2% compounds roughly to $485,000 over 20 years for $1 million portfolio. So those 4 sources of this 2% improvement, let's say, lower fees, avoiding mutual funds and those costs, being less diversified. In other words, not being so overly diversified, you're going to get just average returns, and being more selective. Those are the 4 things that basically work year after year after year. And this mutual fund advisory account that we're talking about here, that fights every one of them, okay? It adds to fees. It locks you into funds. It over-diversifies you. And it strips away any kind of selectivity, okay? It's just basically the same engine running in reverse.
Question 4. So flexibility. Can your advisor make a move tomorrow morning if the market hands them an opportunity? Or do they have to call a committee? Do they have to file paperwork? Do they need to wait 2 weeks? And then everybody else has already moved. My dad can give the real example from this year that speaks to this exact scenario with the AI software sell-off.
So earlier this year, and really over the last year, it's kind of taken place, AI software stocks have really gotten clobbered. It's not really the chip names, it's the software companies. The market panicked over this product release from China that scared a lot of people that AI software was going to basically be commoditized. And within a week, several names who had done really very well had dropped about 20%. Did we panic? No. We're actually looking at these underlying businesses and realized they haven't changed. The narrative has not. And we basically started moving money into these really underpriced stocks, things that had gone down significantly. Now, you can't make a change like that if you're buried inside of a bunch of mutual funds that has you allocated over 4,000 or 5,000 companies. It's impossible.
And Jerry, I want to ask the dumb question because somebody listening is thinking it. Why didn't you panic? The headlines were everywhere. Most people in your seat would have at least trimmed. Why didn't you?
Because we've done our work on all these underlying companies before the news hits, okay? We were ready for this. And when you've done the work, news doesn't really shake you. News shakes the people who haven't done the work and basically have to react in real time. So by the time the AI software company was really out there on every channel, we'd already basically knew what was going to happen. We knew how we wanted to position ourselves. That is what selectivity inside of fear looks like.
And let me bring in the Iran conflict example too, because it ran the other direction simultaneously. When it flared up this summer, two trades opened in opposite directions. Travel names down, oil names up. Jerry, can you walk people through that one?
So, sure. If this wasn't the biggest trade of the century, but basically airlines and hotels, cruise lines, all of that got hammered because everybody got concerned about international travel. On oil names, those basically spiked over supply concerns. So we kind of work both sides of this. A mutual fund prospectus will tell you that the manager has to be in certain buckets. They're not allowed to buy certain things. We don't have constraints like that. So we went through and we basically got rid of some of our oil stocks because they were way up in price and started buying some of the travel-related industries because they were way down in price. And with 95 individual stocks that we have at the moment, we have the ability to move these any particular point that we feel is necessary.
Things are going pretty good too. All right, and that flexibility is one of the most expensive things to live without. We're going to take our middle of the segment beat for the workshop and that estate planning piece, the thing we do for free that you have to have. And then we're going to come back to the interview. Megan, run the workshop again because the workshop is the lowest pressure version of the interview that we're describing all hour.
So the Organized Investor Workshop is something we hold at Chesapeake's on Parkside Drive in Knoxville at 6 p.m. And we do this monthly. You can check out our website for those event dates. We have a nice meal, some adult beverages if you like those, the 60-page workbook that we will give you. And again, that's free. And the same estate planning offer that we are about to walk through. Also, you can get potentially a signed football. There's one up for grabs for one lucky attendee.
It'll say Jerry Goodman, former All-American.
Signed by Erik.
Back by popular demand.
Dad definitely did not play football. He was a Boy Scout. I guess you could sign for that reason.
Do a good deed daily, man.
Okay. Visit us at theorganizedinvestor.com to make your reservation, or you can also call and leave us a message on our reservation line at 865-415-2058. This is not a sales pitch wrapped in a steak. That would be really tough anyways. Yeah. Some people have come to these workshops and they have never actually sat down with us to talk about their situations, and that's fine too. But they do walk away smarter from the workshops, and that's, one of our goals here. We also would love to help you with your personal situation if you would like to have a meeting with us after the workshop.
Well, and speaking of that exact statement, Megan, now the estate planning piece, right? And this segment is where it lives in detail. I'm going to tee it up, let Jerry walk listeners through it because, Jerry, you're the guy that we actually want people to call. So the full explanation, Jerry, set hut.
So listeners, 75% of you listening to this right now, at this moment, on this time, on this radio show, or wherever you happen to be listening, either has not done anything on their estate planning or what they have is out of date, okay? 75% of you. So we have this unlimited annual subscription through an online partner we have called Trust and Will. We pay a lot of money for this. It runs for an entire year. And again, it's similar to a company like, let's say, LegalZoom.com. Now, with that unlimited subscription, we can provide you a complete set of estate planning documents. Again, free of charge, without any cost, any obligation. Now, that package includes the following: a durable power of attorney, which seems pretty exciting, doesn't it? Healthcare power of attorney, advanced healthcare directive, and you can get either a will or a revocable living trust, whichever kind of fits your situation. Now, this covers the listener and their spouse, or if it's a significant other, if you have one of those laying around. It's valid in all 50 states. And we would say this is appropriate for probably 95% of everybody that walks in the door. Now, the 5% that has let's say a complicated situation, they got a second marriage, a blended family, special needs child, business interests, things like that. For that particular person, that 5%, we probably want to have a chat and see if maybe working with a flat fee attorney might be a better fit for your situation. But to get started, you need to call me or Jared. We need to have a brief phone call to make sure that you're in the 95%. And if you are, and most people do end up in that group, we're going to send you a link. And from that point in time, you're going to get, that's where you can get started. So if you have a simple situation that doesn't need an attorney, we're going to send you the link. You can do it yourself. We can give you a little bit of help. We can give you a whole lot of help. All of this completely free of charge. And you can actually come to our office and do this in one trip if you want to. That's how cool would that be, Eric?
I think they should.
So what does this actually cost the listener? We keep saying this, harping on this. We say this forever. People will say it's free, and they'll say, well, how much does it really cost? It's free, folks. If you want to go to a local attorney, it would probably cost you several $1,000s, maybe a bunch of thousands of dollars. We've helped people with this for 25 years, folks. 25 years. We've never received a dime of compensation from any of this, okay? Not any of this. Not in 25 years. We don't make a penny off of any of this.
And let me drop the golden line that I think lands hardest with this week's theme of inertia and estate planning. The day you need it, you can't get it. If you have something bad happen, you have a stroke tomorrow morning, let's say, you can't sign a healthcare directive tomorrow afternoon. If you pass away unexpectedly, your family cannot draft a will at the funeral. Estate planning is one financial decision that has a hard deadline you do not get to see in advance. So call Jerry, please, 865-415-2070. Again, Jerry at 865-415-2070.
And just to anchor what Dad said about the mechanics one more time, you do not have to be a client of ours, okay? You do not have to attend the workshop, although we would love to have you, and you don't have to come into the office. We would love to see you there too, though, if you would like to come in and chat with us. The 5-minute phone call, that just gets you started, okay? And most listeners don't realize that. It's the most important part of the offer, really.
And coming from somebody who was on the listener side 6 months ago, that is the part that surprised me the most. There is no qualifying. There is no, well, only if you sign with us. There is no upsell at the end. You can take the documents and just walk. And the firm has done this for 25 years and never been compensated once.
Back to the interview. We've talked about process, compensation, numbers, flexibility. All right, next question. What happens when you, the advisor, are wrong? Do you tell me, right? Because every advisor is wrong at some point. The good ones tell you. The mediocre ones do not.
And I'm going to be the first one to say we've been wrong sometimes. We don't like to admit it, but we will. Anybody managing 95 stocks for years on end is going to have positions that are not always going to work. The question is, what happens after that? Do we move on? Do we double down on the thesis that is already broken? Do we admit this to the client? This is the test for a real advisor. Not whether you're right all the time, but whether they tell you when they're not.
And you can frame this as a football analogy too. Anybody interested? Well, I'm going to do it anyway. And this is the second one for the hour. All right, long-term contracts in the league, in the NFL, right? Team gives a coach 5-year extension at year 2. They lock themselves in. Year 3, things go sideways. Year 4, everybody knows it's not working, but the contract is the contract. They can't admit they were wrong without writing a check. Here comes the buyout, right? So they let the whole season burn. That is what a lot of advisor relationships actually look like. You signed up, you feel locked in, you'd rather burn another season than admit it's not working, or maybe it's just, I don't want to have the conversation, right? Or whatever it is. Except in your case, the contract is psychological. There's no actual penalty for switching.
Eric, quick question. Why does schools always seem to do that? Like a year or two into it?
When I get an answer to that, I'll let you know.
Oh, okay. I thought
no, it makes no sense.
I thought everybody knew it.
We're afraid they're going to take our coach, but no one's even after their coach. You didn't have to do that. Why'd you do that?
Just curious. Thank you.
And the next question is the one I think most listeners never ask. Who is actually managing my money? Not what firm is on the letterhead, a specific name, a specific human being. At most large brokerages, the answer is a model portfolio designed by people who you will never meet, and they don't know your name. At this firm, the answer is 2 specific names, Jerry and Jared. You can call them. They will pick up.
And that really matters more than you think. At a lot of these large firms, the advisor that your statement says is yours on your statement, they don't pick individual stocks for you. He sells you a model built by somebody in Manhattan or Boston who you've never heard of, okay? They're being measured on how much they sell, not on how it's performing for you. That is not a knock on them as an advisor, as people, okay? A lot of them are good people, and a system pointed the wrong way. The system rewards the sale, not the outcome.
And one I think every listener should ask, what happens to my account if you retire or change firms or go on an extended leave? At a lot of large brokerages, the advisor you sit down with on day 1 is not the advisor managing your account on day 3,000. Advisors move firms, they retire, the client gets handed off, often without a heads up. Here at Tennessee Wealth Management, Jerry, my dad, and Jared, my husband, they run the management. They are the management. There's only 2 of them. They aren't going anywhere, okay?
And one more, a teacher's question. Will you explain it to me until I understand it? Or will you talk down to me? There is a tone some advisors take with women, younger clients, with anybody they assume just won't get it. You will know it when you hear it, and if you hear it, that itself is the answer.
And that is the interview. It's process, compensation, numbers, flexibility, honesty about mistakes, the actual person managing your money, succession, tone. Now, what are you waiting for? Why are you not going to ask your advisors these questions? Most investors know their current advisor cannot pass the interview cold. If you're not going to confront them about all of this, what's the one excuse you'd want me to read on air? Seriously, tell me one. Tell me one I should read. But what's the real reason you are giving your advisor a pass all the time? And that is where we're going to leave segment 2. It's the interview that they can't pass. When we come back in segment 3, it is the Tuesday that never comes. What do you do about all this week? Not someday, not after the holidays, this week. Check it out because we're coming back. You're listening to the Organized Investor Show brought to you by Tennessee Wealth Management.
If you're interested in a more personal learning experience, join us at an Organized Investor Workshop. Erik Ainge and the entire team will be there. The next event is scheduled for Tuesday, June 30th at 6 p.m. at Chesapeake's Restaurant on Parkside Drive in West Knoxville. Attendees will receive a 60-page workbook, a yummy meal, and learn how to get free estate planning documents through our partner Trust and Will. Seating is limited, so reserve your spot at theorganizedinvestor.com or call 865-415-2058. That's 865-415-2058. Erik Ainge is the host of The Erik Ainge Show on 99.1 The Sports Animal, weekdays from 9 to noon. Erik, his wife Susan, Megan Hubbard, and Jerry Goodman are all affiliated with Tennessee Wealth Management and Prospera Financial Services in Dallas.
Welcome back to the Organized Investor Show. It's me, Erik Ainge, and we are in the final segment of the inertia hire. The premise: if your advisor's chair were empty, would you walk in today and would you hire them? Most would not, and yet they keep them. Segment 1 was the invisible bill, what it costs you to stay, but you never see those costs. Segment 2 was the interview they can't pass, the questions most advisors cannot answer cold. Segment 3, here it comes, is the Tuesday that never comes. Because that quiet Tuesday afternoon you're looking for where you finally have time to evaluate your finances, it doesn't exist. The work has to be done in the middle of chaotic life. Quick re-intros: Jerry Goodman, certified financial planner for 43 years and runs the in-house management, deciding what to do, when to do it. Megan Hubbard, that's Jerry's daughter, former teacher, my wife Susan. 6 months ago, she's just, listening, hanging out. Now she's studying for her Series 7 on the team. Susan, you're going to go first in this segment because the Tuesday angle is yours. Again, this is me, Erik Ainge, former QB and host of the Erik Ainge Show on the Sports Animal as well. Susan.
I want to talk about this from the side that I know best. 6 months ago, if you had told me to switch advisors, I would have given you the same list of excuses everybody else gives. I don't know how it works. I don't have time. I'll deal with it after the holidays, after tax season, once the kids are in college, once my parents are settled. And listeners, the next clean window in your life, it's not coming. There is never going to be a quiet Tuesday afternoon when nothing is happening and you finally have time to evaluate your finances. That Tuesday just doesn't exist. The work has to be done in the middle of life. It always has been. Anybody who has ever made a real change in their life made it during a busy season because every season is busy. And the actual time investment, it's tiny. A 20-minute phone call, a read of the statement you already get every month. That is the homework. The hard part is making the call. Once you make it, the rest is just straightforward.
Let me give you a story from last month because, well, it's fresh. So a couple actually came into our office. They had had the same advisor for 22 years. We pulled up their statements. There were 11 mutual funds inside an advisory account. And that is the mutual fund advisory account structure that my dad walked through in segment 2, where there are 2 layers of fees. It's the works, right? So 5-year return, about 6% in a market that did substantially better. They were paying around 1.4% advisory fee on top of fund fees they didn't know they were even paying. We didn't sell them anything that day. We just walked through what they had.
So 2 weeks later, they called basically and they started the transfer to us. And the husband said the line that everybody seems to say. They said, I should have done this 15 years ago. That exact line, I've heard this year after year after year, hundreds of times in many different forms. I should have done this 15 years ago. I wish I'd called sooner. I knew something was off. No one's ever come to the office and said the opposite of that. They said, gee, I really wish I'd waited longer to do this. I mean, it never happens. The regret, it's always one directional. And in 43 years of this, no person's ever told me they regretted moving, ever.
And the answer for that pattern is make the call together. That takes the conflict off the table. You're not arguing about firing anybody. You're asking the interview question Erik gave you in the first segment. If the seat were empty, would we hire him today? I want to add something from the Series 7 studying side because I am living it right now. When you go through the licensing material, you start to see how many ways an account can be structured and how many fee layers can be hidden inside something that looks like one product on a statement. A line item that says managed account, it can hide a separate account fee, a fund expense ratio, a 12B1, and a trading cost, all stacked. Before I started studying, I would have looked at the statement and seen one number. I would have nodded. Now I know what to look for. And that is what we are trying to give listeners, not the license, but the same set of eyes. The interview question Erik keeps asking is the listener version of the same checklist I am being tested on.
Quick numbers anchor before we go further, because segment 3 is about practical action. Through 12/31/2025, so for the entire year of 2025, 1 year, 36.3% versus the Dow at 13. 7-year average at Tennessee Wealth Management was 16.7% versus 10.1. Again, past performance is no guarantee of future results, and returns vary by account. And at a quick callback for that 2% improvement goal for our clients, when you compound 2% improvement on $1 million, it's an additional $485,000 over 20 years. And it can come from 4 sources, right? This is what we do. Lower fees, avoiding mutual funds, less diversification, more selectivity. Same engine, same math every year, boom. And if I could, I'm going to throw one of my footballs in here, one of my football analogies. Susan teed it up for me so perfectly. It's like teams don't draft a quarterback because they have a good feeling about him at a barbecue. They put him in a room. They ask him 3 or 4 hours of questions. They watch how he handles the questions that he doesn't know are coming. They have a process. They have a scouting report. They have the combine, all the film, all the game film to go to. Now imagine the head coach standing up in the war room and saying, let's just take last year's quarterback again. Didn't really love him, but starting over is hard, right? That's a fireable offense in the NFL. If your finances, it's exactly what most households are doing every year, though. Last year's advisor, again. We didn't love him, but we'll just keep him because, starting over can be hard.
The difference is, in the kitchen, nobody is there to fire you for it. You have to be the GM, the head coach, the player, okay? You have to do the interview yourself. And when listeners, they do that interview, here's what we see happen. About half of them realize that the current advisor is fine, but they'll still come over because there's a real difference that still adds up over a 20-year period. The other half realize the current advisor really has been doing them a real disservice for the whole time. Either way, the interview is the right thing to do.
Let me give you a story from last month because, well, it's fresh. So a couple actually came into our office. They had had the same advisor for 22 years. We pulled up their statements. There were 11 mutual funds inside an advisory account. And that is the mutual fund advisory account structure that my dad walked through in segment 2, where there are 2 layers of fees. It's the works, right? So 5-year return, about 6% in a market that did substantially better. They were paying around 1.4% advisory fee on top of fund fees they didn't know they were even paying. We didn't sell them anything that day. We just walked through what they had.
So 2 weeks later, they called basically and they started the transfer to us. And the husband said the line that everybody seems to say. They said, I should have done this 15 years ago. That exact line, I've heard this year after year after year, hundreds of times in many different forms. I should have done this 15 years ago. And I wish I'd called sooner. I knew something was off. No one's ever come to the office and said the opposite of that. They said, gee, I really wish I'd waited longer to do this. I mean, it never happens. The regret, it's always one directional. And in 43 years of this, no person's ever told me they regretted moving, ever.
Before we close out the show, a couple of practical reminders for listeners. First, the workshop, guys. The workshop, because it's the lowest pressure version of the interview Susan and Jerry just described. Susan, you've sat at the events. Tell us what you've seen.
We have held several, and a lot of people say, I almost didn't go. The Organized Investor Workshop at Chesapeake's on Parkside Drive in Knoxville, 6 p.m. monthly, a full meal, adult beverages, the 60-page workbook, and about an hour of education. You don't have to do anything afterwards. You don't have to make an appointment. You don't need to leave a card. Some people come several times before they ever sit down with us. Some never do, and that's fine too. We give away an Erik Ainge signed football to one attendee, so reserve your seat at theorganizedinvestor.com, or you can call us at 865-415-2058.
You know, worst case, you get dinner. Best case, you get an answer to a question that you've been carrying around for years. So we're not pitching anything during dinner. We're there to answer questions, to educate you, to kind of explain what we're about, how we can help you. That is the workshop every single month.
And the third estate planning comment of the four, the reinforce, right? Because we promised 3 touches, and this is touch number 3. Jerry walked the full summary in segment 2. I'm going to take this one because it's really the what are you waiting for moment. All right. So I'm going to keep it short. Guys, it's free. It's a 5-minute phone call to Jerry or Jared to make sure that working with Trust and Will is the good option for you. You don't have to be a client. You don't have to come to the workshop. You don't even have to come in the office, period. And on behalf of every spouse and every kid out there who would be left holding the bag if something happened tomorrow, again, guys, what are you waiting for? You wouldn't wait this long to fix a leaky roof. Your family's your roof. And the day you need it, guys, you can't get it. So please, 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 please call Jerry at 865-415-2070. It's a 5-minute call. You're not signing anything. You are confirming that you're in that 95% that doesn't need to work with a local attorney, and they'll send the link right to you. It's the single kindest thing you can do for the people that you love the most.
And that is a reinforce I cannot top. So I am not going to even try. Listener, make the call this week, not someday, this week. Erik, bring it home.
All right, practical playbook for the week. 3 steps, guys. Write them down. Step 1, pull your last quarterly statement from your current advisor. Don't analyze it yet. Just get it ready. Step 2, go to theorganizedinvestor.com. Look at the published performance. Look at the verifications, the last 4 digits of the client account numbers, and confirm for yourself that it's real. It is. This takes 10 minutes. You've already spent more time than that on like lunch today and what you're going to do, talking about a meeting, to plan, to take another meeting, to go do something else. So just please do that. Step 3, ask yourself the interview question. If the seat for your advisor were empty, would you hire them today? If the answer is yes, that's great. You did the interview, you confirmed your hire, you're going to sleep better. If the answer is no, here's what we do. We pick up the phone and call Jerry, 865-415-2070. Talk to him. He does his Ask Anything in 20 Minutes call. No pressure, no paperwork. Just the interview you didn't do the first time. And by the way, you're going to love Jerry.
And from the listener side, 6 months ago, the work was nothing compared to what I built up in my head. The hardest part was making the first call. After that, it was easy. The myth that you have to get your affairs in order before you make the call is the same trap that keeps people away from the dentist. The dentist would rather see you with a cavity than not see you at all. Same here. So just call us. The first 24 hours after the call, that is the only stretch that feels hard. After that, nothing about the process is heavy. You do not have to know your account numbers. You don't have to bring your statements. You don't even have to have a number in your head. You just have to be willing to spend 20 minutes asking the questions you have been carrying around for years.
And one for the spouse who's listening too. Have the conversation tonight at dinner, just one conversation. Not that we're firing the advisor. What would we ask if you're interviewing someone fresh? Strictly from the beginning, okay? Make a list together. You are problem solving, not arguing. The list itself will tell you whether or not you have a hire or an inertia hire.
I will add one piece for the kids and grown children who are listening too, okay? A lot of the calls we get start with an adult child noticing something on a parent's statement, maybe at Thanksgiving. They don't want to push. They feel like it's not their place, so nothing happens. If you're an adult child listening, you absolutely have permission to ask your parents the interview question. Not aggressively, but just Mom, Dad, when was the last time you actually sat down with your advisor and asked him some hard questions? Sometimes the kid asking is the only push the parent needed. If you take nothing else from this hour, take the question itself. Apply it to your advisor, your accountant, your insurance agent, your doctor, your kid's tutor. If the seat were empty, would you hire them today? You'll be surprised how clarifying that is. Some answers will be obvious yeses, some won't. Pay attention to the ones that aren't. I'm not telling you to fire anybody, I'm just telling you to do the interview.
And that's the show, guys. It's the Organized Investor Show. We called this one the Inertia Hire. Again, it's me, Ainge, with Jerry, Megan, and Susan. Check all this out at theorganizedinvestor.com. Please check out the workshops monthly at Chesapeake's. You can reserve your spot right there at theorganizedinvestor.com, or you can call 865-415-2058 for estate planning. Call Jerry. Again, 415-2070. That's 100% free. And again, all this, you can just go to the website. It's all right there. Super easy. But if you call Jerry, listen, 5-minute phone call, no strings attached. And remember, if your advisor were interviewing for their job today, knowing what you know now, would you still hire them? If the answer is no, you already know what to do. Pick up that phone and let's get to work. Thanks for listening to the Organized Investor Show, brought to you by Tennessee Wealth Management. We'll see you next week.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of the Organized Investor or Tennessee Wealth Management. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional investing advice. Erik Ainge is the host of the Erik Ainge Show on 99.1 The Sports Animal weekdays from 9 to noon. Erik, his wife Susan, Megan Hubbard, and Jerry Goodman are all affiliated with Tennessee Wealth Management in Knoxville and Prospera Financial Services in Dallas, Texas. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning or before making any investment decision. And please consult legal or tax professionals for specific information regarding your individual situation. Brokerage and advisory services are provided by Tennessee Wealth Management through Prospera Financial Services, Inc., member FINRA SIPC. The Organized Investor is a brand name operated by Tennessee Wealth Management for educational platform purposes. Want to meet the team from the Organized Investor in person? Join us at a free Organized Investor workshop. You'll get a 60-page workbook, a great meal, and learn how to get free estate planning documents through our partner, Trust and Will. Our next workshop is Tuesday, June 30th at 6 p.m. at Chesapeake's Restaurant on Parkside Drive in West Knoxville. There's no cost or obligation to attend. However, seating is limited. So reserve your spot at theorganizedinvestor.com or call 865-415-2058. That's 865-415-2058.